Expense versus expenditure. Hi everybody, today we will discuss all about expense versus expenditure. Expense versus expenditure. Are you confused about whether to use the term expense or expenditure? You're not the only one who feels this way. The majority of people believe that these two words are synonymous. While they may be similar, there are some key differences between the two concepts that are important to understand. What is an expense? In business, an expense is an outflow of money to another person or group in exchange for goods or services. Expenses are typically recorded on the company's income statement as a reduction in revenue. Many expenses are incurred in the process of generating revenue. For example, the cost of goods sold, COGS, is an expense that represents the cost of the inventory that was sold to customers during the period. Other common expenses include selling, general, and administrative, SG&A, expenses, which represent the business's running costs, and depreciation expense, which is a non-cash expense that represents the wear and tears on the company's fixed assets. Some expenses, such as interest expenses, are incurred even if the company does not generate revenue. Types of expenses. There are two types of expenses: operating and non-operating expenses. Variable operating expenses, such as COGS, SG&A, and depreciation expenses, are necessary to run the business. Non-operating expenses are not essential to running the business, but they may be incurred during business activities. Interest expense is the most common type of non-operating expense. What is the expenditure? Expenditure refers to an outflow of money, resources, or time. In business, expenditures are often made to generate revenues or profits. Common expenses include raw materials, inventory, office supplies, rent, salaries, and marketing. Expenditures are essential to track because they impact a company's bottom line. If expenses are too high, it can eat into profits and make it difficult to stay afloat. Conversely, if expenses are managed efficiently, it can lead to increased profits and long-term success. Types of expenditures. Businesses should be aware of a few different types of expenditures. These include 1. Capital expenditures. Capital expenditure is a large, one-time expense to purchase assets or improve a company's infrastructure. Examples include buying new equipment or renovating an office space. 2. Operating expenditures. These are ongoing costs associated with business running daily. They can include things like rent, utilities, and employee salaries. 3. Discretionary expenditures. These are non-essential costs that are not necessary for the operation of a business. They can include things like advertising, entertainment, and travel. Businesses should carefully keep track of all of their expenditures to ensure that they stay within their budget. Doing so can avoid overspending and putting their company at financial risk. What is the difference between expense and expenditure? The key difference between expense and expenditure is that expenses refer to the costs incurred during a period, while expenditures refer to the payments made during a period. In business, both terms are used frequently and often interchangeably. However, there is a subtle difference between the two. An expense represents the cost of something during a particular period, while an expenditure represents the payment made during a specific period. While an expense is an outgoing payment, an expenditure is an outgoing payment that has been made. An expense can be incurred without money being paid out, while a term expenditure always involves a payment. Expenses are classified into two types: direct and indirect expenses. Direct expenses can be directly linked to the production of goods or services. Indirect expenses cannot be directly related to producing goods or services. Unlike expenses, expenditures are classified into three types: primary, secondary, and tertiary. Primary expenditures are those that are necessary for the operation of a business. Secondary expenditures are those that are not essential for the operation of a business but are still incurred. Tertiary expenditures are those that are incurred but are not necessary for the operation of a business. Expense versus expenditure, comparison table. Expenses. Expenditure. Expenses refer to the cost of goods or services that are used up in the process of generating revenue. Expenditure refers to the outflow of cash or other assets in order to make a purchase. Expenses are classified as either operating or non-operating. Expenditures can be classified as either capital or revenue. Expenses are recorded on the income statement. Expenditures are recorded on the balance sheet. Expenses impact the profitability of a business. Expenditures impact the financial position of a business. Expenses are incurred when revenue is generated. Expenditures are incurred when cash is paid out. Expenses are tax deductible. Expenditure is not always tax deductible. The amount spent on buying raw materials and other inputs is an expense. The money paid to employees as salaries and wages is an expenditure. Expenses are the costs that are incurred in the process of producing and selling a product or service. They can be direct, such as raw materials and cost of labor, or indirect, such as advertising and rent. Expenditures are the money paid out by consumers on goods and services. They include both durable goods, such as cars and appliances, and non-durable goods, such as food and clothing. Expenditures also include services, such as haircuts and doctor visits. What are the examples of expenditures? There are many different types of expenditures that a business or individual may incur. Some common examples of expenditures include materials and supplies, rent or mortgage payments, utilities, insurance, wages and salaries, tax deductions, interest payments, advertising and marketing expenses, travel and entertainment expenses, legal and accounting fees, repair and maintenance costs. Most businesses track their expenditures carefully to stay within their budget and avoid overspending. Expenses can quickly add up, so it is essential to be mindful of all the money spent. Individuals also have expenditures, although they may not track them as closely as businesses do. Some examples of personal expenditures include housing costs, transportation costs, food and groceries, clothing, utilities, insurance premiums, childcare expenses, savings and investment contributions, debt payments, recreational and entertainment expenses. Like businesses, individuals need to be aware of their long-term spending to stay within their budget. Tracking expenditures can help people save money and make better financial statements and decisions. These are just a few examples of revenue expenditures. Many other types of payments can be classified as expenditures. It is essential to keep track of all payments made when managing expenditure. You may avoid overspending and maintain your budget by doing this. Is every expenditure an expense? Not every expenditure is an expense. An expense is only incurred when there is a decrease in the value of an asset or a liability, such as when inventory is sold or services are rendered. For example, if a company spends 100 Indian rupees to buy supplies, then the 100 Indian rupees would be an expense when the supplies are used. However, if the company still has the supplies at the end of the accounting period, the 100 Indian rupees would not be an expense. It would instead be classified as a prepaid expense or asset. It is essential to distinguish between expenses and other expenditures because only expenses are used to calculate net income. All other expenditures, such as equipment purchases, are considered capital expenditures and are not recorded as expenses. Capital expenditures are instead recorded as assets on the balance sheet. What is the key difference between expenses and payments? Expenses are the costs that a company incurs to generate revenue. Payments are the amounts that a company pays out to its suppliers, employees, and other stakeholders. The major difference between expenses and payments is that expenses are the costs incurred to earn revenue, while payments are the amounts paid to suppliers, employees, and other stakeholders. Expenses can be classified into two categories, direct and indirect. Direct expenses are directly related to producing goods or services, such as raw materials, labor, and overhead. Indirect expenses are not directly related to making goods or services, such as marketing, rent, and utilities. Payments can also be classified into two categories, fixed and variable. Fixed payments remain the same regardless of activity levels, such as rent and insurance. Variable payments fluctuate based on the activity level, such as commission sales and production bonuses. Conclusion. Although the definitions of expense and expenditure are pretty straightforward, it can be challenging to differentiate between the two when you're tracking your spending. Thanks for watching. Please subscribe to our YouTube channel, Accounts Lobby, for solved problems and lectures on accountancy.